Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Friday. Happy Friday to you all, June 5th. And a few economic news releases scheduled for today. Remember, some important events are supposed to happen today, too. We'll get right to it here. Today, the non-farm payrolls for the month of May. So we had back in April, we had 221,000 people apply for, or actually jobs created. These are new jobs created, not final for employment like yesterday, but 221,000 new jobs created. It was supposed to dip to 210 and actually jumped upwards to 280,000 new jobs were created, according to the Bureau of Labor Statistics. So good news overall. On the other hand, we got the unemployment rate, and it was supposed to stay at 5.4, and it jumped up a little bit. And this is being kind of attributed to more people going into the workforce here. So not a huge increase, but more people are entering the workforce, so it bumped up the unemployment rate. Average hourly earnings, we all like to see this. This is going up here. This could be good news for wage inflation here. 0.1% back in April. Forecast is supposed to go slightly to 0.2, and it jumped all the way up to 0.3% in the month of May. So people are making a little bit more money, as we can see here with average hourly earnings here. So good news right there. Currently, the stock market is down. Now, it started the morning off up because obviously we had some good news there. But then after they started thinking about, hey, wait a minute, now this might just go ahead and had the rate hike in the fall because there's been a lot of talk about maybe it will get postponed until 2016 with IMF and everybody else kind of talking that maybe we should we're not really on solid footing, but with job numbers like this coming out and possible wage inflation with the average hourly wages coming up, that maybe the Fed will raise rates in the fall. So now that pulled back, so that good news ended up being bad news. Coupled that with Greece coming back, kind of surprising everybody. Decide they're going to delay their payment instead of making it in each week, the 300 million euros. They're going to basically lump it all up and pay it out one time at the end of the month. So we'll kind of see if they could do that, if it's just a strong tactic or kind of what's being worked on here, or maybe they're working behind the scenes. There's a lot of speculation as to what's going on here, but it kind of surprised the markets with their decision at the last moment to say we're going to pay it all at the end of the month versus in the increment that they were scheduled to make. All right, so let's take a look at the bond market, and bond market tanked again. So very abysmal week here, as you can see, starting from way up here this week and dropping all the way down here in interest rates. So rates have jumped up quite a bit over this past week, you know, again, there's really no logic behind this. Rates should be doing actually quite well, but unfortunately, in this scenario, in this current market, there's really not much logic in it, and rates have crept up as a result of it. So hopefully, we'll get some better news next week. We'll hopefully get a rebound here on the bond market. I think what we're basically waiting for that will help the bond market is when the Fed actually starts raising rates, and that will help out the bond market. So. Because the stock market's been on tear, it's at a very high for the last 7 years, versus actually probably an overpriced position, and a lot of that money, once they start basically, you know, with the 0% interest rate, they're going to basically lose some of that liquidity, and that money will come back into the bond market, with thus seeing a little bit better interest rates, probably looking towards the fall with that happening. All right, folks, you guys have a wonderful weekend. Thanks so much for watching. We'll look forward to see you guys on Monday. Take care.